Imagine this. You're living in London, your clients are in Sydney, and your accountant's losing sleep in both time zones. Welcome to the glamorous chaos of running a business in two countries. You thought moving to the UK would be all pub lunches and Pret sandwiches. But now you're wondering, wait, am I about to get taxed in both countries for the same income? Yes, you could be, unless you play your cards very carefully. Here's what they don't tell you. If you accidentally create what's called a permanent establishment, or PE, in the wrong country, boom! The tax office in that country wants a slice of your profits. Suddenly, you're not just doing business internationally, you're playing tag with two governments. A PE can be triggered by something as innocent as working from your London kitchen if you're still pulling the strings of your Aussie company from there. That's right. You, hunched over your laptop enjoying your PG tips, might be creating a taxable presence in the UK without even meaning to. And when that happens, HMRC doesn't ask politely. They tax. But let's back up. The UK-Australia double tax agreement is here to stop your business profits from being taxed twice. Keyword, stop, not prevent automatically. You still need to structure things smartly or risk a financial facepalm. Let's make this real. You're running an Australian company. You move to the UK. You're still the boss, calling the shots from Camden. That could shift your business's mind and control to the UK. Boom, UK tax residency triggered. Congratulations! You now owe UK corporation tax on top of your Australian obligations. To avoid it, keep the decision-making back in Oz. Have board meetings in Melbourne and a director you trust steering the ship. You? Just chilling in Camden doing the occasional Zoom. That's how you keep the tax office guessing, and ideally, out of your wallet. Now, about moving money between companies. This is where most freelancers overcomplicate everything and can accidentally invite a tax nightmare. Best practice? Let your UK company invoice your Australian company for actual commercial services. It's clean, legal, and tax efficient. The Aussie company gets a deductible expense, the UK company earns income, and you draw your salary or dividends under UK rules. Nice and tidy. Trying to just pay yourself directly from your Aussie company while living in the UK? Possible, but messy. Think PAYE, DPNI, foreign income pages, and enough red tape to gift wrap a tax audit. What about dividends? Sure, but don't expect a tax miracle. Franking credits from Australia? Useless in the UK. You'll likely pay full UK dividend tax. So, it's less smart money move and more accidental tax donation. And if you're wondering whether you even need both companies, you might not. If you're just freelancing from the UK with some Aussie clients, invoice them from your UK limited company and skip the international headaches. Keep the Australian entity only if there's actual on-the-ground business in Australia. Trying to run everything through one company without a strategy? That's how you end up creating a tax presence in a country you didn't mean to and get a letter from HMRC that ruins your week. Oh, and the double tax agreement? It's not a get-out-of-jail-free card. It's more like a parachute, super helpful if you packed it correctly before jumping out of the plane. You still have to claim the relief, track foreign tax credits, and fill in the paperwork. But when used right, it can save you from paying tax twice on the same income. So what's the secret to staying sane? Simple, structure everything deliberately. Know where each company earns its income. Decide where management lives. And move your money in a way that doesn't trigger a tax tsunami. Because when it comes to international business, guessing costs you, while planning pays you.